What's up, everybody? Welcome to the 26th episode of the Investing Penguin, covered calls and cash secured puts. A quick shout out to our newest subscribers, John Byington, Ramabala, Chinita Henderson, Fayez Azrak, Chichi Duan, Eddie Valley, Josh Keach, Cobbs Capital. And a special shout out to John at the CPT dashboard. I am honored that John watched some of my videos and posted comments. This is a big deal, folks. This is like having a celebrity visit your YouTube channel. He's the king of covered calls, the prince of premium, the lord of leaps, the dictator of time decay. When I first started researching covered calls, I was listening to John's videos in the car, at the gym, on the bike. So many thanks to John for motivating me and getting me jacked up to write covered calls and cash secured puts. If you are new to my channel, stick around as I reveal the numbers for the month of January, and stick around till the end as I share some interesting facts about the Federal Reserve Board and Jerome Powell and these darn interest rate hikes. And please hit all those buttons, subscribe, like, and share. It's supposed to help all my YouTube algorithms and make me filthy rich. But seriously, if you appreciate these videos, then please subscribe and share with your investment friends. It's a lot of work making these videos. For those of you who don't know me, I am the Penguin, and in this video I reveal the profits using covered calls and cash secured puts for the month of January. And wow, January was just like December, another roller coaster ride. I can't take much more of these upside down roller coasters. I'm feeling a little woozy. I knew that spicy bean burrito wasn't going to sit well after lunch. Well, before I lose my lunch, let's jump into this. Grab the thermometer. I've got an investment grade fever. Let's take a look at the graphs for January. Here is the Dow Jones Industrial Average, and we are down but not out. We got a little pop at the end of the month of January. Like I said before, now that the New Year's Eve booze and blunts have worn off, reality is starting to set in. I think everyone knows 2022 is going to be a challenging year. All the more reason to be selling covered calls and cash secured puts. Here's the Nasdaq Composite. And here's the S&P 500. So here are my stocks that are on. If you have rolled the dice in a craps game, then you understand the on button. Micron. The chip stocks have been beaten up, so I sold one cash secured put on Micron. The utility SPDR ETF. Trying my luck with the ETFs, I sold cash secured puts in January. Intel. What a disaster in January. I made mistakes, and we will talk in more detail about Intel. Kinder Morgan. I've owned Kinder Morgan since June of 2021 and sold covered calls in January. JP Morgan. Another disaster in January, but I'm sticking with JPM, even though it's down like 15% since the earnings report on the 14th. Pfizer. I bought Pfizer and sold covered calls in January, looking to capture the dividend payment too. Same with Citigroup. I bought Citigroup and sold covered calls in January, looking to capture the dividend payment. 3M. I have sold covered calls and cash secured puts in January. I've been assigned 300 shares of 3M. Nucor. I sold cash secured puts and then Nucor stock tanked right past my strike price. I've been assigned 200 shares of Nucor. Raytheon. That goes in the books as a win. Phillips 66, another W. The Energy SPDR ETF, another win. So here are my stocks that are off, sitting on the sideline and not collecting any premium because the trading price is too far below my purchase price. AT&T stock is killing me. I just have to hold, collect the dividend, and wait for the stock to recover higher so I can start selling covered calls again. This is not what you want, but at least you can collect dividends. So let's review some January covered call trades in greater detail. Citigroup took a beating in December and January, but analysts like the stock and so do I. It also has an ex-dividend date of February 4th. After reviewing everything, I decided to buy Citigroup and sell covered calls. On January 18th, I bought 500 shares of Citigroup at $65.59 a share. I sold 5 covered call contracts for $1.05 for the February 18th expiration and the 67.50 strike price. I collected a premium of $521.69. If on Friday, February 18th, Citigroup closes above 67.50 a share, then on the following Monday, my 500 shares of Citigroup will sell at 67.50 a share. I'm expecting to make a profit of $1,476.24 for 34 days, which will be a 48.3% annualized return. Plus, I will be capturing the dividend payment of $255. If Citigroup trades sideways and never breaks above my strike price, well then I keep the shares, I rinse and repeat and write the same covered call again and keep collecting premium. Pfizer is a stock that I'm always watching. I was thinking of selling a cash secured put, but Pfizer has a dividend payment coming up, so I decided to sell covered calls and capture the ex-dividend date of January 27th. On January 18th, I bought 500 shares of Pfizer at $54.05 a share. I sold 5 covered call contracts for $1.31 for the February 4th expiration and the 54.50 strike price. I collected a premium of $651.69. If on Friday, February 4th, Pfizer closes above $54.50 a share, then on the following Monday, my 500 shares of Pfizer will sell at $54.50 a share. I'm expecting to make a profit of $876.24 for 20 days, which will be a 59.2% annualized return. Plus, I will be capturing the dividend payment of $200. If Pfizer trades sideways and never breaks above my strike price, well then I keep the shares, I rinse and repeat and write the same covered call again and keep collecting premium. So I want to review some of my January cash secured put trades because this is where you can learn from my costly mistakes. These mistakes cost me thousands of dollars. Let's start with 3M. I've owned and traded 3M before. 3M just tanked. It dropped all the way down from 180 and traded as low as 160. I decided to sell a cash secured put on 3M, so on January 10th, 3M was trading at 177.40 a share. I sold 3 cash secured put contracts for $1.65 for the January 28th expiration and the 170 strike price. This was a deep out of the money strike price, so I was taking smaller premium but getting big downside protection, so I thought. I collected a premium of $493.01, which equates to a 19.6% annualized return. Well, on January 28th, 3M closed at 163.10 a share, and now I own 300 shares of 3M at a cost of $170 a share, and my break even is $168.35 a share. So I'm already in the red on this trade. I feel like I didn't make any mistakes on this trade, but the market just got the better of me. I took smaller premium in a deep out of the money strike price. But let's face it, the markets don't care about my feelings. Okay, here is my disaster trade, Intel. From $56 all the way down to below $48. Yikes. I am almost embarrassed to explain this trade. Here are my mistakes. First, Intel had earnings on January 25th and I sold a cash secured put with a January 28th expiration. What the hell was I thinking? I don't even smoke dope. You're never supposed to make trades through earnings. Second, I was chasing premium. I took the big premium and the big return, and my strike price of $55 got destroyed. I should have taken smaller premium and a deep out of the money strike price. That would have saved me thousands of dollars. Third, I let my guard down. I thought Intel was turning a corner in 2022. Intel announced their new CFO, David Zinsser, from Micron. Intel announced a new $20 billion plant in Ohio. They have new plants breaking ground in Arizona. All this positive news, but you can't let the news drive your decisions. Last, I've seen this cycle happen before. Intel runs up, earnings knocks it down. Intel runs up, earnings knock it down. I really made a bad trade. Okay, here's another disaster trade. Nucor, from 115 all the way down to 93. Yikes. So here are my 2 mistakes. First, Nucor had earnings on January 27th and I sold the cash secured put with a January 28th expiration. The bong residue, man. The bong residue. You're never supposed to make trades through earnings. Second, I was chasing premium again. I took the big premium and the big return, and my strike price of 107 got destroyed. Nucor traded as low as $93 a share, and luckily it recovered to 99 a share. I should have taken smaller premium and a deep out of the money strike price. That would have saved me about $1,000. Let's talk JP Morgan. This stock just got hammered after earnings. So here is my mistake on this trade. I should have let the dust settle after earnings. Earnings was on the 14th. The stock dropped from 170 down to 160, and I sold 2 cash secured puts that same day. I thought I was being smart. I took smaller premium and a deep out of the money strike price, but it didn't make a difference. The markets continued to pummel JP Morgan stock. I should have let the dust settle after earnings. Then when JP Morgan got pummeled below 150, I decided to sell another cash secured put for the 149 strike price. This trade actually worked out okay since JP Morgan closed at 146.61 a share, and my break even on this trade is 146.85. But I still should have taken smaller premium and a deep out of the money strike price. So finally, let's talk about a trade that I'm hoping will be successful. I've been looking at the ETFs more closely for covered calls and cash secured puts since they are more diversified than individual stocks. Also, ETFs allow you to focus on a specific sector. I've recently traded the XLE and the XLF and now the Utility Spider ETF. When looking at ETFs, you want to make sure that you review the underlying stocks that make up the ETF. So I decided to sell a cash secured put, and I had the potential to buy 200 shares of XLU at 66 a share. On January 25th, XLU was trading at 67.27 a share. I sold 2 cash secured put contracts for 81 cents for the February 11th expiration and the $66 strike price. I collected a premium of $160.68, which equates to a 26.1% annualized return. Now, if XLU closes below 66 a share on February 11th, I am buying those shares at a good discount, which is fine since I will start writing covered calls. And if on February 11th XLU closes above 66 a share, the option will expire worthless, and I still make a profit of $160.68 for 17 days, which is a 26.1% annualized return. And that is a great return. Well, we discussed a number of trades, so let's review the numbers for January. Over $6,500 in profits for the month of January. So the green is covered calls, the blue is cash secured puts, the orange is dividends, and the purple is stock gains. So in the month of January, I sold 4 covered calls, generating over $2,000 in premium, aka cash flow. Intel, Kinder Morgan, Pfizer, Citigroup, lots of littles can add up to big numbers. Also in the month of January, I sold 10 cash secured puts, generating over $2,800 in premium, aka cash flow. 3M, Intel, Nucor, JP Morgan, Bristol Myers, Verizon, the Utility Spider ETF, Citigroup, and Micron. In the month of January, I captured 1 dividend payment, generating $100 in profits, JP Morgan. And in the month of January, I had 5 stocks called away. I had covered calls on the Energy Spider ETF, JP Morgan, 3M, Raytheon, and Phillips 66, and all these stocks hit their respective strike prices. The gains are not huge, but it goes in the books as a W, a win. I call this the good, the bad, and the ugly. So not every trade is a winner. You have to take the good with the bad, and the losses are just downright ugly. For you millennials, the good, the bad, and the ugly is a great Clint Eastwood spaghetti western. So the month of January, I've got over $20,000 in unrealized losses. These unrealized losses don't really bother me since these stocks all pay dividends and I think they will eventually turn a profit. AT&T and Intel are both killing me right now. So what went wrong in January? Well, I didn't follow the basic rules on my option trades. Don't trade through earnings, don't chase premium, etc., etc. So now I have been assigned shares well below my strike price. I have nobody to blame but myself, and the markets could care less about my feelings and losses. So what went right in January? Well, I scored 5 W's in the win column, and I got super lucky that 200 shares of my JP Morgan covered call trade was assigned early due to the ex-dividend date. I locked in profits at 160, which saved me about $2,600 in potential losses if I still own those shares today at 146. Well, that's it. Is it me or does this seem like a long video? I guess time moves slower when you're losing money. So let's hope February is a better month. More videos are coming, and stick around for 10 seconds more as I share some interesting facts about all these upcoming interest rate hikes. So you keep hearing in the news about all these interest rate hikes coming up to help reverse all this inflation created by our politicians. Before all this inflation, 98% of Americans probably had no idea who is Jerome Powell. Well, now we all know he is the chairman of the Federal Reserve Board, and he just spoke on January 26th about the upcoming interest rate increase. But before we vilify Jerome Powell, there are a couple of things to consider. First, Congress oversees the Federal Reserve Board. Our politicians are the ones that created all this inflation. The Senate and the House of Representatives, and yes, Trump and Biden too, allowed the printing of all this free money. It was like an open checkbook, a complete money grab by all of our politicians, all in the name of COVID. At some point, people have to go back to work and continue with their normal lives. We just can't keep printing free money. Second, interest rate hikes are actually a good thing, as we need to keep inflation under control. Inflation is like a tax. It costs everyone more money. Our food, our gas, our electricity, our products all cost more money. All those stimulus checks that everyone received during COVID seemed like a great idea at the time, but now we are all paying for it 2, 3, 4 times over. It costs you an extra $100 a month to drive your car. Your rent increased by $200 a month for the exact same apartment. Your electric and heating bills also increased by $50 a month. Your grocery bill now costs an extra $200 a month. Your medical bills are increasing. And let's face it, once these prices go up, chances are they are not coming back down. So hopefully these interest rate hikes will curb the inflation rate.
Lady love, she'll lead you on. She'll stay a while and then she's gone. You better go on home, Kentucky gambler.
Money music, Merle Haggard, Kentucky Gambler. Kentucky Gambler is a 1974 song written and performed by Dolly Parton on her album The Bargain Store. Then Merle Haggard covered the song in 1975 and it became a #1 hit on the country chart. Kentucky Gambler tells the story of a miner from Kentucky who abandons his wife and children for the bright lights of Reno. He initially wins at everything he played, but eventually his winning streak comes to an end and he loses everything. Disclaimer: I am not a financial advisor. This video is for entertainment and educational purposes only. And I really hope you enjoyed this video. I am only sharing my experiences and opinions. Investing involves risk, so please seek advice and educate yourself.